Thinking gold and silver are your go-to safe havens? Not so fast. Instead of walking away with billions of profits, their grand plan blew up in their face by March 1980. And even the government was sweating bullets. Welcome back to Money Talks US, China, and Beyond. I'm Chris Lee. Missed our last episodes? Check them out. We dive into a Chinese Communist Party CCP's possible invasion of Taiwan, leading to a global war with the US and sparking a stock market meltdown. Now get ready. In our next episodes, we're unpacking some financial lifelines. Let's explore how to safeguard your wealth. Thinking gold and silver are your go-to safe havens? Not so fast. Here's why they may not be the financial fortress you're told about, if not done correctly. So here's our roadmap. So feel free to jump to any sections with the timestamps we show. First off, gold and silver. They're like the wild kids of the financial world with the dramatic price swings. Back in the 70s and early 80s, gold shot up from $35 to $834 an ounce, but then plummeted 70% back to $250. Silver went from just over $1 to nearly $50 and then back down to $5. Imagine buying near the top. You'll be waiting almost 30 years just to break even. And silver did most of all this in a whirlwind 2-year ride from 79 to 80. So what was the deal with those roller coaster prices? Back in the 79 to 80, three brothers decided to go all in on silver. They nearly single-handedly sent silver price from $6 to almost $50 an ounce. Instead of walking away with billions of profits, their grand plan blew up in their face by March 1980. And even the government was sweating bullets, worried that they would tank Wall Street with their silver shenanigans. So let's dive into this wild tale of Hunt brothers, the masterminds behind the biggest silver squeeze history has ever seen. You might recognize the name Hunt from the late Lamar Hunt, who not only founded American Football League, but was also the former owner of the Kansas City Chiefs. So to get the full scoop on how the Hunt brothers pulled off the silver squeeze, we gotta go back to the Hunt family origins. It all kicked off with H.L. Hunt, an oil tycoon who struck gold, oil, in the East Texas oil field. By 1957, he was rolling in it with assets estimated between $400 and $700 million, making him one of the richest dudes on the planet through the 60s. But our saga really begins with his sons, Nelson, William, and Lamar. After H.L. passed in 74, the brothers were set to inherit this massive oil fortune. Fast forward a few years, and their wealth was still ballooning. But by 79, the Hunt brothers had a different kind of game plan up their sleeves, one that no one saw coming, and which could have sent the entire financial market into meltdown mode. All right, back to the silver story. In the 70s, after the US ditching the gold standard with fears of economic collapse and the nasty beast called stagflation, people were scrambling for safe haven, stocks, real estates, you name it. And of course, precious metals like gold and silver became the go-to for preserving wealth. Some big-time investors started betting on silver, expecting a windfall. But instead, they got a facepalm. They felt the silver market was being manipulated, keeping pricing low. That ring a bell? The Hunt brothers, they were definitely part of that camp. So what do you do when your investment isn't popping like you hoped? You start buying more, trying to corner the market, right? Well, that's easier said than done, unless you're loaded like the Hunt brothers. And that's exactly what they set out to do in 1979. Back then, silver was still quite cheap, trading at just $6 an ounce come January. But the Hunt brothers, they were about to sit on their hands. They started hoarding physical silver like no one's business, creating the biggest silver stockpile the world has ever seen. And when they almost ran out of cash, which was in hundreds of millions, did they call it quits? Nope. They just keep the ball rolling, keep buying more and more silver future contracts. Wait a minute, what is future contracts? All right, let's do a quick Futures 101 crash course, because that's where things got really, really juicy. Say, silver's kicking at $20 an ounce. Instead of shelling out the full 20, you just drop $2 down, which lets you control the shiny piece. And you pay the remaining $18 when the contract matures. So future lets you hold a bunch of silver with just something like a dime on a dollar. And that's what they call buying arm margin. Keep that in your pocket for a minute. Now here's where it gets really interesting with the Hunt brothers. They didn't even cough up the full $2. They got banks. They got brokers to lend them some. Hey, they were billionaires. They were with assets all over the places. So let's say they just put down $1 to control an ounce of silver worth 20. Here's the twist. If the silver jumps to $30 when the contract is due, they laugh all the way to the banks with $10 profit on their one. That's a 10x, tenfold return, man. But if it swings the other way, a mere $1, $1 drop, the initial investment goes poof, gone. And the Hunt brothers weren't playing with 1 ounce. They were buying millions and millions all the way. So multiply that risk and reward by tens, even hundreds of millions. And you get the picture of what they were up to. Everything seems to be going according to plan at first. Silver prices were soaring like they were on steroids. Thanks not only to the Hunt brothers, but also because their 2 Arab sheiks and some shadowy investors through a Swiss bank were stockpiling the metals like there's no tomorrow. People definitely caught on. Suddenly there's a silver shortage. Jewelry prices are through the roof. And everyone is turning their homes inside out for silver to cash in on this madness. According to a classic Washington Post article from back then, folks were even warned about a surge in home burglaries trying to snatching silver. The government, they couldn't ignore it. James Stone, the honcho at the CFTC, Commodity Futures Trading Commission, was ringing the alarm bells. He was worried that the Hunt's silver scheme was so huge it could bring down the house if they defaulted on their loans. We're talking about potential financial Armageddon here, threatening the stability of major brokerage and causing a commodity market meltdown. So places like a COMEX, where the Hunts were playing their big plays, big bets, started putting the brakes on, tightening up the rules for buying silver future contracts. But silver prices, they just keeps rocketing. And the Hunt brothers, they were like more and more at the peak. They had their hands on about 200 million ounces of silver. That's roughly half of all the silver that had ever been mined up on Earth to that point. We're talking a cool 4.5 billion worth of the shiny stuff. The Hunt brothers' silver stash was so massive, it caused nationwide shortages. And I mean shortages so bad that even Tiffany took out a newspaper ad to call them out. They were basically saying, hey, these guys are cornering the market and now everyone else has to pay through the nose for the silver. By January 1980, silver was trading at a dropping $49.95 per troy ounce. The Hunt brothers would have made billions of dollars settling their future contracts and rode off into the sunset as 3 of the richest men in history. Except that's not how things plan out. The downfall of the Hunt brothers kicked off on January 7th, 1980, just a year and a half into their grand scheme. COMEX, pressured by the government, decided to drop the ultimate bombshell that introduced what's called Silver Rule 7. This rule was a game changer. Literally, no kidding, game changer. It suddenly limited how much silver you could buy on margin in a big way. Remember when you control $20 worth of silver with just 2? Well, now you'll need closer to 10 for that same $20 silver. And it also put a cap on how many silver contracts it could hold. Go over that limit, well, guess what? You got to start selling off. The market's reaction was like watching a balloon pop. In just 4 days, a silver price nosedived by over 50%, going from a high of $50 to $25. Talk about a swift kick to the silver stack. Here's where the Hunt brothers had this huge Achilles heel in their master plan, one that would ultimately bring them down and shake the entire U.S. economy. Their fatal flaw? They were only paying like a buck. Remember the buck? A buck or even less for each $20 per ounce of silver they controlled. But when push came to shove, they couldn't cough up the full price to actually buy all that silver they had hoarded via future contracts. Now, when you're investing on margin with borrowed cash and your bets starting going south, the futures exchange and the brokerage firm that lent you the money, they're not messing around. They're going to hit you with something called margin call. In simple terms, it's like them saying, hey, you better pony up more cash right now to cover potential losses, or else we're going to selling off your stuff. For the Hunt brothers, the margin call was again unprecedented. Just 1 day after Tiffany's ads on March 27th, the price of silver plummeted again from about $22 to £11, one of the biggest one-day drop in silver history. The Hunt brothers got hit with a margin call, demanding a cool $100 million to keep their silver empire from crumbling. That day went down in infamy as Silver Thursday. The Hunt brothers were staring down the barrel of a whopping $1.7 billion losses. And they couldn't cover that $100 million margin call either. But defaulting on a bet of this magnitude wasn't just their problem. It sent shockwaves through almost every American market, especially the silver sector and the investment bankers who had banked on their success. J. Paul Getty once said, if you owe the bank $100, that's your problem. If you owe the bank $100 million, that's the bank's problem. And on Silver Thursday, man, did that wisdom hit home. If the Hunt brothers couldn't make that margin call and had to cut their losses on their silver bets, they would lose nearly everything, wiped out. But the banks, they would go down in flames right along with them. Government officials were freaking out, along with the markets, as silver price kept tanking in March 1980. If the banks and brokers who had loaned the money to Hunts went belly up, we're talking about domino effect here. The ripple effect would have hit the U.S. economy hard, threatening disaster across the board. And let's not forget, this was a time when the U.S. was already wrestling with stagflation. Prices went up, prices were soaring, but wages not so much. The last thing the government needed was another economic catastrophe on their hands. You might already guess how this whole story ends. When a bank is too big to fail, you better get bailed out. Yes. So a bunch of major U.S. banks, with a nod from Federal Reserve Chair Paul Volcker, band together and threw the Hunt brothers a lifeline, a $1.1 billion credit to help them pay off their previous loans without causing chaos. Fast forward to 1982, and the London Silver Exchange was quoting silver at around $4.90 per ounce. That's a 90% drop from the peak during the Hunt brothers' silver heyday. Talk about a fall from grace. The brothers ended up losing around $4 billion, had to cough up $160 million to the IRS in taxes. And by 1988, after losing a lawsuit, they were on the hook of another $134 million to a mining company that got burned by their silver scheme. They declared bankruptcy in a Texas court that same year, but true to form, the Hunts bounced back, focusing on what they did the best, oil. They climbed back to become one of America's richest family again. But their story, it was like a horror movie, stuff of investors' nightmares. A cautionary tale about trying to outsmart the market. What Hunt brothers, just greedy thieves trying to make silver impossible to buy, but ended up as victims of their own games? Or were they savvy business tycoons brought down by the system changing the rules mid-game. What do you think? I may put up a poll so everyone can vote. But one thing is for sure, this kind of drama doesn't happen when you are buying silver, stocks, real property, you name it, with your own money, your own hard-earned cash. As Nelson Bunker Hunt said after the whole mess, don't buy on margin. What a gut-wrenching roller coaster, isn't it? Okay, now let's go back to this whole idea of gold and silver being your safe haven when the stock market goes belly up. If you're hoping they're going to save you from the market madness, you're in for a shock. Take a look at how gold and silver did during past crises. When the COVID-19 chaos hit in 2020, in a month, the S&P 500 plummeted by about 32% at the worst. Gold didn't drop as sharply, down still by 10%. But silver? Well, it went down like a lead balloon, just like stocks. All of them took a hit in the same month. And during the 2008 financial crisis, all three went down a drain together, especially after Lehman Brothers went bankrupt, go belly up in early September. Gold fell by about 30%, the S&P by almost 45%, and silver followed right behind into the abyss. Even the dot-com bubble in 2000 didn't spare them. About a year or so after the bubble burst, gold dropped by about 13%, silver by 17 to 18%, with the S&P falling 22%. Why does that happen? Well, at the start of a crisis, when the stock market collapses, people's investment take a nosedive, and they start getting those dreaded margin calls. Yeah, the same margin calls. Again, monkey never learns, huh? They needed cash, so they needed cash. And I mean like right now or yesterday, but their funds are tied up in all kind of different assets. So what do they do? They start selling off whatever they can, fast, in a panic. Gold and silver are usually first on a chopping block because they're liquid and can be sold quickly. This panic selling leads to a fire sale where price get depressed because everyone is trying to get out at once. It's like trying to exit packed concert through one tiny door. The rush causes chaos and people might just take whatever price they can to get out of the mess. All right, here's the final kicker for gold and silver. They're just like any other commodities in one key way. They don't generate any income. They don't pay dividends like a profitable business or interests like bonds. They just sit there looking pretty, when at the same time you cross your fingers and hope their prices go up. So you'll remember when Warren Buffett was on stage at the 2011 Berkshire Hathaway's annual meeting. There was this moment, someone in the crowd threw him a question about gold and commodities. Buffett, in his classic style, gives this epic spiel about how this is all about betting on what others will pay in the future.
It isn't going to do anything. Yeah, it's all you are doing when you buy that is that you're hoping that somebody else a year from now or 5 years from now will pay you more to own something that, again, can't do anything.
We would love to show you the whole clip, but we're going to keep it short as we don't want to get into any copyright drama. Wow. So, after all this, do you still have the guts to buy gold and silver? Or should you even bother? We're going to dive into that in our next episode of Money Talks US, China, and Beyond. And if you like what you see here, make sure you subscribe, like, and share, and tell us what you think in a comment. We'll see you soon.